The reason why I like to talk a lot about index investing is because all of the financial managers out there who manage billions of dollars, they're going to pick technically more losers than they are winners. We can't consistently pick winners. When you invest in an index, whether or not you are an advisor or a do-it-yourselfer, the index is doing that for you. Essentially, the market is determining the winners and the losers, and you're just there for the ride. Everyone likes to talk about how they can pick winners. Those are often survivors, and most of those will not be honest with you. This stock that we saw earlier was actually NVIDIA, and you probably would not have held it after two major market disruptions. But if you did, you'd definitely be sitting in millions of dollars of wealth. Problem is, would you have held on long enough to get there? So here we're actually comparing that stock's performance relative to its index, which in this case is the S&P 500 index. When you look at both of them together in this format, why would anyone buy an index when you can just YOLO into a single stock and win big? This is the effect of hindsight bias. We're talking about you invest $100,000 3 years ago, and today you would have over $800,000. Meanwhile, if you would have bought the index, you would end with $200,000. So even then, that would still be a great result. Now, when we look at the last 12 months, we do see that divergence is more or less diminished. And from there, we can see that if you would have invested a year ago $100,000, today you would be sitting on $140,000. Whereas if you bought the index, you would be sitting in at $110,000. Not a bad thing. One thing you'll notice is that one has a lot more volatility than the other. Now, when we go ahead and add a much larger index, the second index is the US total equity. So these are all the stocks in the US, all under one index. There is a bit of a divergence. It's just under the S&P 500. One thing you're probably noticing also is that the volatility of the S&P 500 is much higher than the US total market index. And that's very important because we're trying to find consistency, stability, predictability. We added a new index, and that is the MSCI World Total Return Index. And we see that it actually is outperforming the US total market, but underperforming the S&P 500. This is a more diversified index, but you would have also had a much smoother ride on the way. The All World Index probably would have been a much better choice than putting all your eggs in one basket, like NVIDIA or Meta or a basket of stocks. My name is Carlo, and I'm also the personal finance columnist for the Montreal Gazette. And if you have questions, I would love to hear them.